Welcome to MarketTamer.com. Yesterday we were speaking about the fact that the markets had risen substantially and we'd crossed above some key moving averages. One of the stocks we discussed was Apple. We spoke about the fact that given the very bullish move on high volume, likelihood was that it would continue higher. That's in fact what happened today. What's surprising about that is that the rest of the market actually experienced tremendous difficulty. Not so much the Nasdaq. The Nasdaq actually did drop, but it didn't drop substantially. In fact, given the magnitude of the rise the previous day, this correction today would have been deemed very much within the bounds of normality. But some other positions did in fact drop further, some other indexes I should say. Russell Small Cap was holding up reasonably well. It did drop further, down 2%, but where we saw greater drops was in the Dow and also the S&P. Here, the Dow we see dropping about 173 points or 2%. Now, this is substantial because it's put us back in what we might describe as limbo land. We really can't say for certain what the direction of the markets will be. And what we did mention was the fact that with all of the money that has been printed, the likelihood was for increased volatility. We're seeing that not only on a daily basis now, almost 200-point moves up and down. That would have been almost unheard of a few years ago. But we're seeing it just in terms of percentage moves up and down in the overall markets. You can see obviously a huge drop down in the markets, huge move up, and 30-40% moves are very, very uncommon historically over the course of any given year, let alone twice within the same 6 months. And this is the kind of volatility we believe we should anticipate and expect going forward. That being said, we're looking at certainly yesterday we were looking at the fact that the likelihood based on yesterday's move was for a continued move higher. With that being said, we also noted that bear calls should still work well, given that there were resistance levels coming down approaching the Dow around 8,800 here, and also a Bollinger Band right above the market. So we're sticking, certainly in terms of the positions we're sticking with the bear call thesis. That is that the markets may move flat, down, sideways, maybe even slightly higher, but no matter which of those directions it moves in, the bear calls can still work well. The only moves that will not work well for the bear calls are aggressive moves up. So in spite of the expectation that a move up might continue here, the market's contradiction to that expectation is not hurting any of the positions, any of the bear call positions that we were discussing yesterday. And ultimately, that's what it comes down to, is figuring out how to profit in spite of a movement that contradicts an expectation. And the bear calls are especially valuable at this time because they build in so much margin. And given the degree of volatility, given the fact that we've come through so far in this trend and our current skepticism of it, which we expressed a few days ago, it all points to sticking with the positional thesis of the bear calls for now. It's certainly working well. The market is proving difficult to judge on a daily basis, certainly after today's move. But today's move, again, was not a move that violated the 20-day moving average. So in spite of the magnitude of the move down, it's not signifying to us that the bullish trend has been broken yet. So we have to stick with what the market is telling us. And for now, let's continue with that thesis. We'll continue making money with the bear calls until the market dictates that that is not the play. And nothing that happened today would suggest otherwise to us. So everything looking good so far. And we'll return with more tomorrow. For now, we wish you the best and look forward to seeing you.